Hey everyone, Scott here, and it's been a while since I did one of these videos, but it's good to be back. We've been working on a lot of exciting projects at Carlson, and I've also been pretty busy at home with a little project in the form of my firstborn daughter, Navy Janae, who's about 3 months old as I'm recording this video. It's been a lot of fun, but it hasn't left me a lot of time to work on these videos. I'm excited though to get back to doing them, and today I'm going to actually revisit one of the videos I did late last year. I think it was late October of 2021, where I talked about corrections and bear markets and crashes and how often they happen, what's it look like when they do happen. So we're going to revisit that. We're going to talk about this year's correction here in 2022, what's unique about it, and then I'm hoping to leave you with maybe some good news as we wrap up this video. So let's jump right in. Okay, so corrections, how often do they happen? Well, correction, remember, is a drop of 10% or more, and a correction happens every 1.5 to 2 years. They happen really all the time. We're gonna have to go through a lot of corrections throughout the course of your retirement. We can't avoid volatility completely if we want returns that are going to beat inflation. Think of volatility, think of times like this as kind of the toll you pay to get the long-term returns that we need to beat inflation. We could put all of our money in things that don't have volatility, that don't have the ups and downs, but it's going to be hard to beat inflation if we do that. And so this right now, this volatility, it's the price we pay to get those long-term returns. And I'm sure a lot of you are feeling it. We all are. It's not fun to go through. Right now, the S&P 500, it's down about 13%. Now, that's the S&P 500. What about the NASDAQ? The NASDAQ is in a bear market. So the NASDAQ is down about 20% as of the time of this video. Now, bear markets don't happen near as often as corrections, but they happen maybe more often than you think, about every 7 years. So once again, we're going to have to deal with bear markets multiple times throughout the course of your retirement and throughout the course of your investing lives. So NASDAQ, it is comprised more of tech and growth stocks, which have lagged some of the energy and value stocks. So that's why the NASDAQ's down 20%, whereas the S&P is only down 13%. In past years, that was completely flipped. So those aren't always going to align. Now, what is the average drop of a correction? This is interesting. So the average drop when a correction happens is about 13%, and it lasts 4 to 6 months. So those corrections happen, they take about 4 to 6 months. Well, guess what? This is right where we're at. We are in the thick of it. We're at a 13% drop on the S&P, and it's been about 4 months, maybe 5 months at the time of this video. So we're right in the thick of an average drop in the S&P 500. Now, it hasn't been average in a lot of ways, and the reason it hasn't been average is that historically and conventionally, advisors, investors have used bonds as the safe part of a portfolio. You use stocks for your growth, and you use bonds as kind of the safe haven. Now, unfortunately, that is not really working in 2022 with rising interest rates. And it's something that we've kind of had on our radar for a few years, that when rates rise, that won't be good news for bonds. And it is happening in full force here in 2022. So long-term bonds, this is a 20-plus year treasury bond fund, TLT, is down about 19% in 2022. Now, short-term bonds, they're not immune. Now, when we use bonds, which we sparingly use bonds, we're usually using alternatives to bonds. We're using fixed index annuities, things that can't drop when the market drops, and things that aren't as tied to interest rates and have no downside. So that's what we've been using as alternatives. But if we've used bonds for one reason or another in your portfolios, it's been short-term bonds, and they're not totally immune, but they're only down about 3% in 2022. So big spread between long-term and short-term bonds, but the historical conventional 60-40 stock bond portfolio not working out too great this year, because usually when stocks are being sold off, bonds rise, and that's not happening this year. Other reasons that this correction is unique. Well, I think it's unique from the sense that there's only one U.S. sector that's positive. Can you guess which U.S. sector, which part of the market is positive in 2022? It's energy. It's ExxonMobil. It's Chevron. It's companies like that are energy focused. Lots of reasons for that. That we're not going to get into all of the reasons that energy's up, but you probably know why, and you felt it. So energy is up. Every other sector in the U.S. is down. I think it's unique that energy's up this year because over the last 3, 5, and 10 years, up until 2022, energy was the worst performing U.S. sector. And finally this year, they're having a good year, and they knocked communication sector into that last spot over the last 3, 5, and 10 years. And kind of the last reason I'm going to give you for why I feel like this is a unique drawdown, and it's how long it's been since we've had this long of a drawdown. You go back to 2020, bigger drawdown than this, right? But it happened quick. February, March, and then boom, things spiked back up when the Fed started coming to the rescue, and lots of money was printed and things like that. Got some good news from COVID, all that. 2020 recovered quickly. 2018, we had a correction. Things bounced back really quick in 2019 from that. This is the first time in a long time that we've had to go 4 or 5 months where it's just kind of this sustained drawdown, and we're definitely feeling it. I know you probably are at home as well. Now, last little tidbit though that I'm going to leave you with is there's a survey, an investment survey. So I want you to ask yourself before I go into this, do you feel bullish over the next 6 months? Do you feel bearish over the next 6 months? Or are you somewhere in between? Well, that's a question that gets asked to investors every single week dating back to 1987. It's called the AAII Investor Sentiment. That's a mouthful. And last week, it was 59% bearish. Okay, so 59% of investors surveyed think that over the next 6 months, the market will go down. That is the 5th most bearish that the survey has been going back to 1987, and it's the most bearish since March 5th, 2009. So you're probably like, Scott, why are you telling me this? This is not making me feel good. Well, this right here is what's unique. March 5th, 2009 was darn near exactly the bottom of the great financial crisis from 2007 to 2009. Here's the returns on the S&P 500 after that most bearish survey in March of 2009. A year later, the market was up 68%. 3 years later, up 114%. And 5 years later, up 205%. Now, what does this mean for right now? Probably nothing, okay? Past results in no way guarantee future returns or future results. Teresa, our compliance officer, I hope you liked that. I hope that was enough. Guys, we don't have a crystal ball. All of these stats I'm giving you, it just provides context. It's just history is not going to be able to provide us the exact roadmap we need to take, but it gives us context to kind of know where we're at in relation to other corrections, other bear market. All right, so I hope that helped provide a little bit of that context and helps you understand kind of where we're at in general with this correction. Hang in there. I know it's not fun to go through, but this is that cost of admission to get that long-term return that we need. And since it is very volatile, that's why we have that foundation set up for you as well in your financial house. So if you need to get in for a meeting with an advisor to go over your plan, give us a call, 844-CARLSON, and we'd be happy to see you. Have a great rest of your day, and we'll talk again soon.